Hey everyone, and welcome to today's Explainer. Today we're going to objectively decode some really intense, highly charged economic warnings recently laid out by financial analysts Lynette Zang and Francis Hunt. We're talking about the big stuff here: fiat currency, physical assets, and massive global wealth shifts. Look, whether you're the kind of person who tracks financial markets every single day, or you're just wondering why in the world your grocery bill keeps going up, you're going to want to stick around. This analysis offers a totally fascinating look into the hidden mechanics of global wealth.
Now, the source material dives into some pretty heavy economic theories, so to keep us focused, we're going to follow a quick roadmap. First, the precious metals paradox. Second, how gold migrates to the east. Third, the hidden wealth erosion. Fourth, taxation on unrealized gains. And finally, strategies for wealth preservation. All right, let's jump right in.
Starting off with Section 1, the precious metals paradox, or paper markets, versus physical reality.
So Hunt and Zhang pose this really intriguing mystery. We often see these sharp drops in the spot market for precious metals. That's the everyday price you see scrolling across financial news. And when that happens, everyday investors naturally tend to panic and sell off. But the analysts argue that if you take a step back and look a little deeper, there's a completely different story playing out behind the scenes.
And this perfectly illustrates their core argument. There is a massive disconnect between the paper trading market and the actual physical delivery market. It's like two different worlds. Everyday retail investors are trading these paper contracts and basically getting shaken out by emotional trading the second prices drop. Meanwhile, central banks and institutional investors, the so-called smart money, are actually using those exact price drops as a huge discount to accumulate long-term physical bullion. So they aren't just trading numbers on a glowing screen, they're taking actual physical ownership of the metal.
To really understand the scale of the game being played here, just look at the price barrier. According to the analysts, a standard physical gold contract on the major exchanges is 500 ounces. At current prices, that costs north of $2 million. It's wild. This staggering price tag explains exactly why everyday mom-and-pop investors simply can't take physical delivery. It basically leaves these massive institutions to scoop up all the physical metals, while the general public is completely distracted by falling paper prices.
Moving right along to Section 2, gold migrates to the east, and the global reshuffling of wealth.
The source highlights a pretty stark dichotomy going on in the global economy right now. They argue that Western capitalist nations are basically drowning in credit card debt, just constantly managing short-term crises, and heavily relying on fiat currency, which, remember, means money backed by nothing more than government decree, not physical commodities. But on the flip side, they note that Eastern nations, especially China, are heavily accumulating physical assets to build long-term monetary resilience. We're talking about gold literally, physically moving to places like Hong Kong and Switzerland, where it gets refined and very often ends up right in China.
To map out the timeline of this systemic vulnerability, the speakers point to a few key historical markers. First, they see the creation of the Federal Reserve back in 1913 as the true origin point for the loss of sound money in the U.S. Fast forward to the 2008 financial crisis, which they argue triggered a K-shaped recovery. Basically, the wealthy shot straight upward, while everyday folks watched their wealth just decline, which they say fueled a broader shift towards socialism. And this whole timeline leads right up to a very specific aggressive spike in institutions taking physical delivery of metals, a spike they actually observed for January 2025.
Which brings us to Section 3, the hidden wealth erosion and the illusion of purchasing power.
Okay, here is a seriously sobering metric for you to consider. According to Zhang's research, the US dollar currently retains less than 3 cents of its original purchasing power. 3 cents! It really forces you to stop and think about what your cash savings are actually worth today.
The analysts argue that whenever we hear the media talk about a strong dollar, it's honestly just an illusion. According to them, inflation isn't some accident, it's a deliberate tool. By inflating the currency, governments can quietly reduce the real value of their own massive debt obligations. So to the average person, it looks like their house or their stock portfolio is going way up in value, right? But the reality is, the currency's actual purchasing power is quietly collapsing in the background. It's essentially transferring the burden of national debt right onto the shoulders of everyday citizens through currency debasement.
Now let's look at Section 4, taxation on unrealized gains and the threat to private property.
Hunt points out what he considers a terrifying paradox for property owners, the unrealized capital gains tax. Normally, you're taxed when you sell an asset for a profit. Makes sense. But this proposed policy would actually tax the increase in an asset's value before you ever sell it or receive a single dime in cash. And because fiat currency debasement artificially inflates asset prices, just like we talked about a second ago, this proposed tax effectively penalizes citizens for the exact same inflation that the government itself created.
And guys, this isn't just some fringe theory floating around the internet. Hunt's research found that this kind of tax has already been discussed or floated in 22 nations, almost entirely Western nations, too, with Brazil and Colombia really being the only exceptions. He notes that Holland even considered a massive 36% levy. The analysts warned that if you get hit with a huge tax bill on a property you haven't even sold, you suddenly become a forced seller just to cover those taxes. And who do you think buys those assets? According to Hunt, it's massive corporate entities like BlackRock, Vanguard, or State Street. They describe this as a stealthy backdoor to eliminating private property without ever explicitly making it illegal. Hunt argues this could literally push the middle class into a modern form of serfdom.
Finally, let's wrap up with Section 5, Strategies for Wealth Preservation and Building Independence.
So, what do we do about all this? Well, rather than relying entirely on digital financial systems, Zang advocates for a highly balanced, tangible approach to wealth and survival. She suggests dedicating portions of your resources to securing essential daily needs. We're talking food, water, and energy security. Next, she recommends holding silver for everyday barterability, then utilizing gold and specialized collectibles for long-term wealth preservation. She specifically notes that collectibles are a lot harder for governments to overtly confiscate. And finally, rounding it all out by building a strong, reliable, local community for full-spectrum independence.
The overarching theme of their entire analysis is beautifully summarized by this one concept. The entire global fiat system is held together by absolutely nothing more than public confidence. That's it. And Zang points out that recently, confidence in the US system fell to an all-time low, dating all the way back to 1952. When that public confidence finally breaks, they warn, the illusion shatters practically overnight.
So based on these heavy warnings from Zang and Hunt about rising global debt, shadow taxes, and institutional maneuvering behind the scenes, it leaves us with a really vital question to consider. Seriously, take a look at your own portfolio. If the digital numbers on your screen just disappeared tomorrow, what tangible value would you actually hold? Thank you so much for joining me for this explainer. I know it's a lot of heavy material to process, but understanding these macro trends is the absolute first step to navigating them. Keep questioning, keep learning, and I'll see you in the next one.